We are going to start an exciting morning with withholding tax. It's a topic that a lot of people will always query on, ask what it's all about. This is an outline of what I'm going to cover today. What is withholding tax? Accounting for withholding tax. What happens when you fail to deduct withholding tax? We'll go through various types of withholding tax. Then we'll focus a little bit on services and what I've categorized as the right to use, and last but not least, interest. So what is withholding tax? It is essentially a tax collection mechanism. It imposes an obligation on payers to deduct tax on payments made to taxpayers. The payers become tax collection agents for the IRB. You note that withholding tax is actually a taxpayer's tax, but the person who remits the tax to the IRB, or the Inland Revenue Board, is not the taxpayer, but the person who makes some sort of payment to the taxpayer. Withholding tax is essentially a tool to ensure that certain types of taxpayers whom the IRB believe may not voluntarily pay their taxes to ensure those taxes are paid. As withholding tax is essentially a tax collection mechanism, the underlying tax we'll look at is still income tax. It falls under the Income Tax Act. What happens when one fails to deduct the withholding tax? Note that the consequences is on the payer, the person who made payment to the taxpayer. It does not have any consequences on the taxpayer himself. If the payer fails to withhold the tax and remit the tax to the Inland Revenue Board within the stipulated timeline, there will be a 10% penalty on the unpaid withholding tax. This, however, does not apply to the withholding tax under Section 109 capital C. I'll discuss that briefly under the types of withholding tax. The second consequence is non-deductibility of the gross payment made to the taxpayer or the recipient of the money. This only applies to Section 107 capital A, Section 109, Section 109 capital B, Section 109 capital F, withholding tax. Finally, the IRB can recover the withholding tax and the penalty as a debt due by the payer. Even in the cases where the payer decided not to take a deduction of the gross payment made, the IRB can still come after the payer for the withholding tax and the penalty. So how do you account for withholding tax? The payer has to remit the withholding tax to the IRB within 1 month of paying or crediting the recipient, which is the taxpayer. In the case of a REIT or property trust fund, the withholding tax has to be remitted within 1 month of distributing the income to the recipient. 1 month in this case means the corresponding date of the following month minus 1. Say you make the payment to the recipient on 18 August today. You have to account for the withholding tax by 17 September. That's what it's meant by corresponding date of the following month minus 1. What happens if the payment date or the date that you have to remit to the Inland Revenue Board falls on a public holiday? Under the Interpretations Act and based on certain case law, the due date will fall backwards to the next working day. Now, the IRB has clarified that this is provided on that public holiday, the counters of the IRB, the payment counters are not open. If it is open and on a public holiday, you still have to go and pay the tax on that public holiday. Under Public Ruling 4/2005 on withholding tax on special classes of income, the withholding tax is due within 1 month of paying or crediting. Crediting is defined in the public ruling as the amount that is available to or for the benefit of the recipient. It is all a question of fact that you have to analyze and see whether an amount is actually having been paid or credited. In my line of practice, sometimes I get inquiry on what happens when a person decided there's an amount due from the payer to a non-resident for interest. Then they decided to capitalize the interest. Is that deemed to be paid or credited? The answer is yes. It will be deemed to be paid or credited. The types of withholding tax. What we're covering here is the withholding tax under the Income Tax Act. There are essentially 8 types. We'll look at Section 107, capital A. The recipient of this payment are non-resident contractors. The nature of the payment is what is termed as contract payments. The rate of withholding tax is 10 plus 3%. 10% on account of the non-resident company or non-resident contractor, and 3% on account of the employees of the non-resident contractor. It is treated as an advance payment of tax, which means the non-resident contractor is technically required to file a tax return in Malaysia to determine its actual tax payable. This withholding tax under Section 107A can then be set off against the actual tax liability. The form to be used when remitting the withholding tax is CP37A. The next type of withholding tax is Section 109. The recipient is a non-resident person. Non-resident person who has no business in Malaysia. The nature of the payment is interest and royalty. The withholding tax rate is 15% in respect of interest, 10% in respect of royalty. This is a final tax, which means that is the rate. The form to be used is CP37. The next form of withholding tax is Section 109A. The recipient is a non-resident and public entertainer. Nature of payment is termed as remuneration, so it can be in kind. Rate of withholding tax is 15%, is a final tax, and you use pro forma B to account for the tax. The other form is Section 109, capital B. The recipient here is a non-resident person. The payments that applies is Section 4A income. Section 4A income is essentially made up of 2 types of service income and 1 in respect of right to use. I'll discuss this in more detail later. The rate of withholding tax is 10%. It is also a final tax. The form to be used is CP37B. Now, in the cases where the final tax apply, if the non-resident does not have, or the recipient does not have any other form of income in Malaysia, they technically do not need to file a tax return in Malaysia. The rates that has been stated there in respect of final taxes can be reduced by an applicable tax treaty. So you have to look back at the tax treaty to see whether a rate lower than this 10-15% can apply. Next, we'll move on to Section 109, capital C. The recipient is a resident individual. The nature of payment is interest. The rate of withholding tax is 5%. This is a final tax, and the form to be used is CP37C. Now, the interest here refers to interest for deposits placed with licensed banks in Malaysia. Banks under the Banking and Financial Institutions Act or licensed under the Islamic Banking Act. However, this withholding tax has been exempted since 30th August 2008, so you don't really use this anymore. Section 109, capital D. It applies to resident and non-resident person. It's in respect of the distribution of REITs, Real Estate Investment Trust, or Property Trust Funds. There's 2 rates stated here, that's 10% and 25%. 10% applies to individuals, resident and non-resident. 25% applies to non-resident company. Sorry, the 10% also applies to a foreign institutional investors. That's your pension funds or collective funds. Note that the withholding tax does not apply to a resident company. This again is a final tax. The form to be used is CP37E for REIT. Section 109, capital E, is very similar to 109D. It applies to resident and non-resident person. It is in respect of distribution for family funds, etc. It's mainly insurance related. 8% when you pay to an individual or institutional investor, 25% for non-resident companies. Again, a resident company is not caught. But it doesn't mean that they don't have to account it in their tax return. This is the final tax. The form to be used is CP37E bracket T. Section 109F. This was introduced in 1 January 2009. An interesting concept. I'll discuss in more detail later. But it essentially covers payments to non-resident persons. The payments caught are Section 4F income. Rate of withholding tax is 10%. It is a final tax. The form to be used is CP37F. The Section 109F withholding tax can be reduced by a relevant DTA tax treaty. When you submit the form to the Inland Revenue to account for the withholding tax, the Public Ruling 4/2005 on special classes of income state, you have to enclose the invoice, remittance slip. The remittance slip is when you make payment, your bank will have a remittance slip. Now, I've come across cases where the amount in the invoice does not match the amount in the remittance slip. And what the IRB will come back is, and if the amount in your remittance slip is higher than the amount stated in the invoice, they'll come back and ask you for the rest of the invoices. Now, if your other invoices are all non-withholding tax type of payment and it's clear from the invoice, then it's not so much of an issue. But you have things that are controversial, then it may open up a can of worms. They may dig further and ask for more information. So it's essential when you submit your form CP37 and when you remit your payment to the non-resident, if that payment is a withholding taxable payment, put it under a separate remittance. Don't group it together with all your other types of payment. Okay? What we have covered so far is a general overview of what is withholding tax and how it basically applies in Malaysia. We'll put a little bit focus on a few provisions, mainly relating to payments to non-resident companies or non-resident persons. I've put them into certain groups. The first group is services. Services cover 4 groups. There are basically 4 types of provisions governing services. Section 107A. Section 107 capital A covers contract payments. Services in connection with the use of property or rights, installation, operation of plant, etc. Section 109 capital B sub 1 sub A. This is also known as Section 4 capital A sub 1 payment. Technical advice, assistance and services, Section 109B sub 1 sub B, also known as Section 4 capital A2 income. Section 109F, it applies to Section 4F type of income. Since they all relate to services, when you want to account or determine whether withholding tax applies, it is best to go through each of these sections one by one. You should go through 107A first, 109B sub 1 sub A, followed by 109B sub 1 sub B, and Section 109F. Of course, if you find when you go through Section 107A and you find that 107A applies, there's no point going through the rest, right? Section 107A, contract payments. This applies to contract payments to non-resident contractor. It is noted that this provision does not have a Section 15 derivation section, unlike Section 109, 109B or 109F. This one is without. Basically, if you make a contract payment to a non-resident contractor, it falls within 107A. Contract payment means work or professional service rendered in Malaysia in relation to an undertaking, project or scheme in Malaysia. So it only applies to services rendered in Malaysia. If services are rendered outside Malaysia, 107A doesn't apply. And if it's in respect of purchase of goods, it also doesn't apply. Under Public Ruling 4/2005, the IRB clarified that where the non-resident contractor has a business presence, in the case of a where no DTA applies, or a PE, permanent establishment, in the case where there is an applicable tax treaty in Malaysia, then you apply Section 107A. So if the non-resident contractor does not have a business presence or PE in Malaysia, 107A doesn't apply. Note that this concept is not in the Act. It is something that is brought about in the public ruling for administration purposes. Again, they created the concept of business presence. This is not defined in the Act. You will not find it in the Income Tax Act. So people will ask, what is a business presence? What is a PE? PE is fairly simple. Just look at the applicable tax treaty and you find the definition of PE inside there. It will help you. Business presence, I don't know. But it will be expected that it should be similar to PE. One would, however, expect, given the concept of DTA, which is to prevent double taxation or prevent worse off tax situation, you will find a person should be easier to create a business presence in Malaysia compared to a PE. Now, if a non-resident contractor is found to have a business presence or permanent establishment in Malaysia, Section 107 capital A withholding tax will apply. The non-resident contractor has to file a tax return in Malaysia, and they can set off the withholding tax against the Malaysian tax liability. If the non-resident contractor do not have a business presence or PE in Malaysia, 107A doesn't apply. That's according to the public ruling. And then you move on to the next form of withholding tax to see whether the next one applies. Services in connection with the use of property or rights, installation, operation of plant, etc. under Section 109B, sub 1, sub A. This also applies to services rendered in Malaysia in connection with the use of property or rights belonging to or installation or operation of plant, machinery or apparatus purchased from a non-resident. There is a derivation section that goes with this under Section 15B. The payment is deemed derived from Malaysia if it's paid by a resident of Malaysia. Alternatively, if the payer is not a resident of Malaysia, then you look at whether the expense is charged or expense in the accounts of a business carried on in Malaysia. Accounts of a business carried on in Malaysia denotes the need to have either a business presence or a permanent establishment in Malaysia. Now, this definition or this particular provision in this derivation section is slightly different from that found in interest and royalty, the Section 109 type of withholding tax. The withholding tax rate is 10%. Now, if the non-resident is found, if you found that 109 sub 1 sub A does not apply, then you move on to test the next one. Section 109B sub 1 sub B. Technical advice, assistance and services. Technical advice, assistance and services rendered in Malaysia in connection with technical management or administration of any scientific, industrial or commercial undertaking, venture, project or scheme. Public Ruling 4/2005 in the case of Esso Petroleum Malaysia, it was found that the word or and the comma in technical advice, assistance or services should be read disjunctively, which means you must read it as technical advice, technical and non-technical assistance, technical and non-technical services. The ambit is very, very wide. However, Public Ruling 4/2005 also said that this provision does not apply to headquarter allocation for ordinary day-to-day routine administration expenses that is not related to specialized services. Examples given were invoicing and bookkeeping. Other examples given in the public ruling includes guarantee fees and commissions, which in the public ruling say it does not fall within 4/2005. The derivation section is the same as Section 109B sub 1 sub A. That is, the payment must be made by a resident of Malaysia or the expense is charged in the accounts of business carried on in Malaysia. the withholding tax is 10%. We have gone through Section 107 capital A, 109B sub 1 sub A, and 109B sub 1 sub B. They all relate to services performed in Malaysia. Hence, when planning the acquisition or the procurement of services from non-residents, perhaps it has to be first considered whether the non-resident will need to, or will, what are the risks of the non-resident having a business presence or a PE in Malaysia. If the risk is high, then what you can do is split the contract into two sections. Services rendered from outside Malaysia or can be wholly rendered from outside Malaysia can be performed by a foreign company to the Malaysian client. Set up a Malaysian subsidiary for services that needs to be rendered in Malaysia. Under this option, the payments made by the client to the foreign company will not be subject to Malaysian withholding tax because no services is rendered in Malaysia. But the Malaysian subsidiary, in respect of services rendered in Malaysia, will be taxed at the prevailing corporate tax rate. If there is no risk of a business presence or permanent establishment, what can be done is you split the agreement, split the contract, and segregate the thing clearly in your agreement. Services rendered from outside Malaysia versus services that needs to be rendered in Malaysia. Either you split into two separate agreements, or if it's in one agreement, you identify clearly what is in and what is out. Your invoice should correspond with the agreement. And of course, in reality, it has to match also. You cannot be pushing everything to outside Malaysia when in reality there are things to be done in Malaysia. Payments made by the client to the foreign company for services rendered outside Malaysia will not be subject to withholding tax. Services rendered in Malaysia, there's a 10% withholding tax, unless reduced by a DTA. Now, after you go through 107A, 109B, and then you find that, hey, withholding tax doesn't apply because both sections, I don't fall within those three sections. You then need to test 109F. As I said, this is a new provision that came into effect 1 January 2009. It applies to gains or profit, or rather, Section 4F is defined as gains or profit not falling under Section 4 small a to small e. So what you need to do is go through small a to small e. Oh, anything that doesn't fall under those categories is a Section 4F provision payment. Now, Section 4F, unlike the 109B and 107A, it doesn't say that the services has to be performed in Malaysia for the provisions to apply. So this applies regardless of where you do the services. Can be in Malaysia, outside Malaysia. Clarification is given under Public Ruling 1/2010. As a guidance, the IAB say that payments falling under Section 4F are payments that is revenue in nature. It doesn't fall within 4 small a to small e, and it doesn't fall within Section 4 big A. Means 109B type of payment. If you fall under 109B, you wouldn't get caught under this. That's why this provision is applied last. Okay? And it applies to casual or occasional income, and it's applied on isolated transaction. There is an absence of repetition. That's essentially what they're trying to catch. The derivation section for 109F is the same as that of 109B. Payment by a resident, or the expense is charged in the accounts of business carried on in Malaysia. The withholding tax is 10%. Public Ruling 1/2010 says that Section 109F will essentially cover commissions, guarantee fees, and introducer fees. If you recall, I said earlier under Public Ruling 4/2005, if you go through that, they already said commission and guarantee fees don't fall within Section 4 big A. So it was off the hook of withholding tax for a while, so now it's back into the picture under 109F. This doesn't mean that commission, guarantee fees, and introducers fees will automatically be caught by Section 4F or 109F. The public ruling says that it doesn't apply to Section 4A income. There may be situations, say, a bank is giving a guarantee and it receives guarantee fees. That guarantee fee will form the business income of a bank. So the withholding tax will not apply in that scenario because it is in respect of the Section 4A income. Now, Section 4A refers to gains or profits from a business. And business is defined in Section 2 of the Income Tax Act to include adventure or concern in the nature of trade. Adventure or concern in the nature of trade can cover one-off situations. So this contradicts or doesn't really jive well with the casual, occasional income, isolated transaction, and absence of repetition part. So eventually, you still have to look at the facts of the transaction to determine whether the withholding tax applies. But this will normally court individuals more than companies. Public ruling 1/201 says that if you determine 1097A doesn't apply, 109B doesn't apply, and you look at 109F and you still think withholding tax doesn't apply, you are required to keep the following documents: copy of business contract of agreement, copy of auditor's confirmation that verifies the income derived by the non-resident is in the ordinary trade profession, copy of non-resident's audited accounts, copy of notice of assessment of the non-resident, and copy of business registration license of the non-residents. There's actually a lot of documents to take, but this is in the public ruling. And practically, you may have difficulty getting this from your suppliers or the person who provides the services. And then they require the copies of evidence to be certified as true copy by the issuing agency or the notary public. Mind you, notary publics are not cheap. And the best part, which is also in the public ruling, the facts of the case may indicate that the income falls under Section 4F, although document presented proved otherwise. So even if you give documents that says, hey, I have all these documents, so Section 109F doesn't apply, then they'll say, yeah, but your facts say it applies. I don't care about the documents. That's essentially what this provision is saying. So I don't know what can prove it. After services, now we'll move to right to use. Right to use essentially covers two types of provisions. That's royalty under Section 109 and use of movable property under Section 109B, sub 1, sub C. Royalty covers the right to use or income from alienation of copyrights, artistic or scientific works, patents, designs or models, plans, secret processes or formulae, trademarks or tips for radio or television broadcasting, or other like property or rights. It also covers know-how or information concerning technical, industrial, commercial, or scientific knowledge, experience, or skill. This basically covers intellectual property types of rights, the intangibles. Now, it doesn't matter where this right is used or is located. The royalty doesn't have the services performed in Malaysia equivalent that it needs to be used in Malaysia is called. The derivation section just says if it's paid by a resident of Malaysia or if it's charged against income accruing or derived from Malaysia. So this is a slightly different test compared to 109B, which talks about charge to the accounts of a business carried on in Malaysia. In my analysis, I would think this is basically because royalty withholding tax does not apply when the non-resident has a business presence in Malaysia. So they have to tweak the test. The withholding tax rate is 10% unless reduced by an applicable DTA. The next category is use of movable property. This is part of your Section 109 trilogy, and the payment here is also referred to as Section 4 Big A sub 3 income. It covers rents or other payments made for the use of movable property. Movable property refers to something that you can hold, more tangibles, but that excludes real property. Now again, it doesn't matter where the property is located or where it's used. This withholding tax applies so long as the derivation section is fulfilled. The derivation section is payment by a resident or the payment is charged in the accounts of a business carried on in Malaysia. Slightly different from the royalty case. Under Public Ruling 4/2005, they do have, actually this is in the addendum to the public ruling. They do talk about rent, bareboat charter, time charter, voyage charter, they are all caught under 109B sub 1 sub C. And interesting to note is that they also cover rental of space in a ship, what they refer to as slot charter. So space, something like intangible, is still caught. Withholding tax rate is 10%. Now, although under the Income Tax Act, you see two different provisions applying to right to use. One is the royalty provision, the other is for the use of movable property. They have different sections, different derivation section as well. The use of movable property under section 109B sub 1 sub C can, under a tax treaty, be categorized as a royalty. In most DTA, royalty is defined to include the use of industrial, commercial, or scientific equipment. So they can recharacterize the use of movable property into royalty, and if the DTA provides a lower rate for this royalty, then the lower rate will apply. We have looked at various categories of withholding tax. And the withholding tax provisions are drafted in such a way that you should be able to fit things into their respective pockets. And theoretically, it's supposed to be done easily. But practically, of course, we always find ourselves sometimes struggling where to fit it in. If the withholding tax rate under domestic law is 10% and is not reduced by any tax treaty, it shouldn't be much of a problem so long as the rate that is withheld is paid correctly to the IRB on a timely basis. But sometimes the problem is you don't even know what to call it. Examples. What do you make of a rental of space in an exhibition hall? We've talked about rental of space in a ship, slot charter. Here, so rental of space in an exhibition hall, how do you categorize that? I suppose we can argue that it's a rental of space in an immovable property. The hall can't move, so we can argue perhaps withholding tax shouldn't apply because it shouldn't fall within 4A3, which applies to movable property. Your use of space here is tied back to an immovable. But you have to be careful, because sometimes when you rent an exhibition hall, you're actually renting the table and chairs, not so much of a space. Then table and chairs can move. You can even take it home, you know. So careful how your contract is drafted and what you are actually paying for. The second type is lease line. Lease line, when you pay for a lease line, are you paying for a service? Oh, service performed outside Malaysia. If you choose Malaysian party pays for an advertisement in a Singapore television program, what are you paying for? Airtime slot, is that a service? Or you're paying for a space in a television program or a space in the broadcasting station? Can it be a royalty? Or can you even say, well, I'm broadcasting my advertisement, so it's actually using your satellites. Okay. Mobile games. Young people like to download mobile games onto their handphones and they play it all the time. For the person, you and I, individuals, who download the games, I think it's fairly easy. You download and you pay Maxis. If you download from the Maxis type of website or DG website, you just pay Maxis or DG the telephone charge or whatever extra payment you have to pay for the game. What is the telco paying the content provider? Are they paying for the right to use an IP, intellectual property, that means the game? Or can this transaction be structured such that the content provider is actually engaging the telco as their service provider so that it can use or write on the telco's network to get to you, the users, to download the game? There's no concrete answer to all of this. These are situations that I've tried analyzing in my line of work. Essentially, it all depends on the agreement. what is actually transacted, how the invoices are issued, who is issuing to who, and how it's accounted in the accounts. Okay? So there's no hard and fast rule about this. You have to analyze each transaction on its own. Interest. Withholding tax to non-resident will not be complete without a discussion on interest. Interest is not defined in the Income Tax Act. But if you look at various textbooks or case laws, it essentially is a compensation for the use or retention by one person of a sum of money belonging or owed to another. The derivation section for interest is quite lengthy. If you look at 109, the services and the right to use movable property, and royalty, they just talk about payments made by a resident. In interest, apart from being a payment made by a resident, the money must also be tied to Malaysia, either used for the production of Malaysian source income or secured against Malaysian property. Then you'll be caught. Or, if you fail the first test, the second test is the interest is expense against income accruing in or derived from Malaysia. So this leg of the derivation section is the same as royalty, simply because if the interest is attributed to a business carried on in Malaysia, withholding tax does not apply. Simple. But for interest, there's a whole list of exemptions under the Schedule 6, which says withholding tax doesn't need to be made. Schedule 6, paragraph 33, the recipient is a non-resident person. The payer is a licensed financial institution, either licensed under the BAFIA, Banking and Financial Institutions Act, or the Islamic Banking Act. Paragraph 33, big A, the recipient is a non-resident company, and the payer essentially is a type of security. SC-approved Islamic securities or debentures issued in Ringgit Malaysia. Paragraph 33, big B, the recipient is any person, and its payment in respect of Securities Commission or LOFSA approved or Labuan Financial Services Authority approved Islamic securities originating from Malaysia in non-Ringgit Malaysia. Paragraph 35. Individuals, unit trusts, listed closed-end funds. Those are the recipient. And it is in respect of Securities Commission approved debentures or Islamic securities. Paragraph 35A. Recipient is unit trust. It's payment made by a licensed financial institution. So anything that is any interest that falls within these categories will not be subject to withholding tax. And it allows a whole lot of avenue to do tax planning, really. That's all for my presentation. Thank you.